Do banks see my every financial mistake? Unveiling the credit report mystery. Ever applied for a loan, a credit card, or even an apartment and felt a pit in your stomach as you hit submit? You're not alone. Our financial history can feel like a dark secret, shrouded in mystery. But the truth is, there's a system in place that lenders use to assess your creditworthiness, and it all boils down to a little report called a credit report. But who exactly gets to see this report? Does every bank you apply to know about that time you maxed out your credit card in college? Buckle up, because today, we're diving deep into the world of credit reporting bureaus, specifically Transunion, and how they interact with the banks you deal with. The credit report, your financial fingerprint. Imagine your credit report as a financial fingerprint. It contains a detailed record of your borrowing habits, including loans, credit cards, payment history, and even public records like bankruptcies or judgments. This information is collected by credit bureaus like Transunion, Equifax, and Experian. So, do banks use Transunion? Let's break it down. The short answer? It depends. Banks don't have direct access to your credit reports from all three bureaus. However, when you apply for credit, you typically authorize the bank to pull your report from one or maybe even all three bureaus. This allows them to get a comprehensive view of your financial health. Here's the key takeaway. While Transunion can't directly tell every bank about your credit history, it can be part of the picture a bank uses to make a decision about you. But it's not the only player in the game. Beyond Transunion, the credit bureau trio. Transunion is just one of the big three credit reporting bureaus. Each bureau collects information from different lenders and creditors, so your report might vary slightly between them. This is why it's important to check your reports from all three bureaus regularly for any errors or discrepancies. Why do banks use credit reports anyway? Think of it like this: if you were lending someone money, wouldn't you want to know if they're likely to pay you back? Banks use credit reports to assess your creditworthiness, which is basically a fancy way of saying how reliable you are with borrowed money. A good credit score, a numerical representation of your credit report, indicates you're a responsible borrower, making you more likely to be approved for loans and get better interest rates. Conversely, a low score might raise red flags for lenders, making it harder to get approved or resulting in higher interest rates. Beyond the score, what else do banks look at? While your credit score is a crucial factor, it's not the only thing banks consider. They might also look at your income. How much money do you make to afford the loan repayments? Debt-to-income ratio. How much debt do you have compared to your income? Employment history. Are you employed with a stable income source? Loan purpose. Are you borrowing for a car, a house, or something else? Understanding Transunion and your financial future. Now that you know how Transunion potentially interacts with your bank, here are some key takeaways. Monitor your credit reports regularly. Check for errors that could be dragging down your score. You can access free credit reports weekly from Annual Credit Report. Build a positive credit history. Make timely payments on your bills and manage your credit responsibly. Don't be afraid to shop around. Different banks use different criteria for loan approvals. Don't settle for the first offer you get. By understanding how credit reporting works and taking control of your credit health, you can empower yourself to navigate the financial world with confidence. Remember, your credit report isn't a permanent record of past mistakes. With consistent effort, you can rebuild your credit and unlock better financial opportunities. With that said, thanks for watching, and until next time.